Hey everybody, today I want to bring you a stock that to me looks like it is a very good value right now. It is a stock that I think is just a forgotten stock in the stock market. Not many analysts are following the company, and it's really been thrown in the dump heap on the side. This is a stock that was trading at $200 a share in 2022. It's dropped all the way down to $65 here today. So that is almost a 70% drop. If you look at year over year, it's down roughly 45%. This company's paying roughly a 2% dividend. Their forward PE is around a 5. They're at historical lows. I think it is one of those stocks that I think is going to do quite well going into the future. So we're going to talk about that here today. So the company that we're discussing here today is Concentrix Corporation, ticker symbol CNXC. So this company is a customer service type company. This is a company that I think has a very, very boring business model. It's in a very, very boring industry. Another reason why this is just a forgotten stock in the stock market. When I read their annual report, I read really anything about this company, management always keeps talking about CX. And so I wanted to know, what does CX mean? After digging into their website, I discovered that CX merely means customer experience. So if you hear the acronym CX anywhere that you're looking or reading about this company, it means customer experience. So that's great, but what does this company do? So if you pick up the phone and maybe you had a product that broke and you want to know about the warranty, maybe you're changing flights for an airline, and you're calling a customer service rep to talk to them, there's a decent chance you're talking to a rep from Concentrix or one of their peers. This is a company, this is an industry that is all about customer experience and service. Concentrix, like their peers, are outsourced by other companies to handle all the customer experience services. This slide here is from their 2023 sustainable report. Now, I will say these are slightly outdated numbers. So looking at this particular slide, they're saying their trailing 12-month revenue is about $6.4 billion. Now, they did about $1 billion more than that in 2023 as a whole. This is a very, very sticky business. In fact, 16 years of average tenure of their top 25 clients. So once they get a client, the retention rate is very, very high. In early 2023, this company was ranked 553 on the Fortune list. They do business in over 40 different countries on 6 different continents. They have over 1,000 clients. And this particular slide says they have over 130 plus Fortune Global 500 clients. That number has actually gone up to over 155. This company has seen some pretty good growth over the last 2 years, and quite a bit of it is from inorganic growth from mergers or acquisitions. And one of the largest ones they had is Webhelp in 2023. So this is a company that is based out of Paris. So they're in Europe. They bought them for about $4.8 billion. Now, on the surface, it certainly looks like they overpaid or a pretty hefty price for this particular company. It's the reason why their debt has gone up over the past couple of years, which we'll talk about when we look at their financials here in a little bit. But it's important to note that they've been able to grow their revenue from around $6 billion up to around $7.5 billion in 2023, and they expect to be around $9.5 billion of revenue in 2024. Keep in mind, again, the market cap is only at $4 billion right now. From the research I did, the reason why they paid a premium for Webhelp, or at least kind of a higher price for them, is that a lot of their other peers were also bidding for this particular company, and Concentrix really felt like they really needed to kind of go over the asking price or have a higher asking price in order to get this company and merge it into their business model and be able to leverage the current clients that they have. The company believes their total addressable market is roughly $550 billion. They believe with Webhelp, they're able to reach more customers across the entire world. And the combined footprint is over 70 countries with 500 plus delivery locations. So one of the slides I mentioned earlier that some of the data in that particular slide is outdated, and one of those is their client base. So WebHelp specifically has around 1,000 clients. Concentrix has around 1,000 clients. So between the two companies in total, they reach over 2,000 clients as their base. So let's take a look at some financial numbers right now. Now, keep in mind that the company spun off CNXC back in 2021. So that's when they debuted on the NASDAQ as an independent, publicly traded company. So I usually like to look at 10 years worth of financial history. Unfortunately, we're not able to do that with this particular company, so we're going to work with what we have right now. So back in 2021, the market cap was around $8 billion. Today it's trading at only $4 billion. So the market cap has dropped more than half since 2021. Now, from a sales per share standpoint, they've been pretty much flat. You can see EPS has dropped 22%. Free cash flow has been up 3% per year. Book value per share has been up 11% per year. Return on invested capital has averaged around 7%. I think investors in the market in general have been very worried about the earnings per share drop in general. But keep in mind, with a couple acquisitions that they made, they do have merger and restructuring charges of well over $100 million over the last 2 years, which has impacted the business. In addition, you have to keep in mind when you do buy companies and you try to merge them into your company, there are a lot of SG&A operating expenses that do take place as you're trying to figure out how to bring both companies together as one. And certainly Concentrix has been dealing with that over the last 2 years with a couple of key acquisitions that they made, including WebHelp. So I think that earnings per share drop off is short term. I do think they'll have some impacts in 2024. But even the company has said that they should have around $120 million of synergies between 2023 and 2024 after eliminating a lot of the redundancies between WebHelp and also Concentrix on the SG&A front. So I do expect their earnings per share specifically and their operating margins to grow moving forward compared to where they've been at the last 2 quarters. Nonetheless, the 11% growth per year for the book value per share is a really good sign that the company is able to grow its assets versus its liabilities. So even though the sales per share has been flat, we've seen a drop in EPS, it is a very, very good sign that their book value per share is growing. And again, I do think the acquisition of WebHelp significantly impacted these numbers. So let's take a look at some balance sheet metrics to kind of see how the company is doing from a balance sheet standpoint. So when I look at a company, I want to make sure that they're not highly leveraged. They don't have a lot of debt on their balance sheet. One metric I like to look at is their long-term debt payoff based on their free cash flow. I like to see that at 3 years or less. Now, currently, the company is sitting at 10 years. However, the free cash flow that they experienced, the drop-off in 2023, had a big impact from their WebHelp acquisition that they made. So a lot of these drop-offs that we saw in the last year, I think, are one-time or short-term impacts for this particular business. However, I do not want to overlook their long-term debt by any means. It is around $5 billion right now, and their market cap is $4 billion. A lot of that long-term debt that they've increased over the last year came from that WebHelp acquisition. Now, when we take a look at their debt to equity ratio, it currently is at 140%. So that is a growth from about 100% in 2022 to 140% in 2023. And again, a lot of that debt that they brought on was from that WebHelp acquisition. I personally like to see debt to equity under 100%. However, I do expect their free cash flow to grow pretty robustly over the next couple of years. In fact, in 2023, they are roughly around $470 million. Over the next 3 years, I do project that their free cash flow is going to grow to about $1 billion. So during that time frame, they should be able to pay down a lot of their debt and also maintain that dividend that they're paying right now, which currently yields 2%. At the same time, if we take a look at their current ratio, which is working capital, currently it's at 1.4, so they have plenty of current assets to cover their current liabilities. Now, if we take a look at the market multiples and also the margins of the company over the past few years. Now, the PE in 2021, when they went public, got up to about a 25. Currently is trading around 11 today. So what's interesting is that their peer group is trading around a 16 to 17 on average for PE. Now, I do think that significant drop in PE is really tied to their debt that grew in 2023. Their gross margins have been very consistent, hanging around 36%. Their operating margins have averaged 10% over the past few years. So we take a look at all these numbers on one page now. Just a quick summary. The positives I see out of this, plenty of working capital. Their margins have been very consistent over the past few years. Their book value has grown 11% per year, so their assets have grown quite a bit compared to their liabilities. However, on the negative side, the company has increased their long-term debt, growing to about $5 billion here today, which has also increased their debt to equity ratio. And because of the Webhelp acquisition they made in 2023, it significantly impacted their sales per share and their earnings per share number due to the additional costs and also additional shares that came to market from that acquisition. But like I talk about all the time, it's not about the past, it's about the future and where the company is going. So you cannot always depend on historical numbers to tell you where the company is going. And certainly over the past 12 to 18 months, there has been a drop off on some of the fundamentals. But like I said earlier in this video, I think those are short term. Something else that's important to note is not just the elevated debt that occurred in 2023 on why the stock has dropped almost 70%. So over the past 12 to 18 months, I think any companies that have been linked to artificial intelligence have done extremely well in the market. You look at NVIDIA, you look at Meta Platforms, you look at Microsoft. Any company that the market believes that artificial intelligence is going to help has significantly inclined or at least had a boost for the most part. However, on the flip side of that, companies that are deemed that artificial intelligence is going to hurt have significantly got hurt or punished by the market, and Concentrix is one of those companies, and certainly that industry in general. One of the biggest risks for buying into this company, at least from the market's perspective, is that they believe that artificial intelligence is going to take over the customer experience, and that companies like Concentrix or their peers will no longer be needed in the future. However, from the research I've done, Concentrix and a lot of their peers are actually leveraging artificial intelligence to help their business. I also believe that the customer experience, or at least the personal contact with a live person and not a computer, is something that will continue to be needed going into the future. So I think an industry like customer experience is not going away, but it is certainly going to change over time. But it doesn't mean that a company like Concentrix is going away. Now, does that mean the revenue could get impacted negatively in the future? It could possibly mean that, but also could mean that they're more efficient on the bottom line. If they're able to leverage, say, computer data and maybe not a person, cutting down on labor and being more efficient because of it's computer driven. So I personally don't think the customer experience is going away, at least from a live human, but each investor must make that decision themselves. So now let's take a look at some valuations to figure out what a good buy price for the stock is and what the fair value could be for the stock based on some assumptions that we'll make in this video. And first off, let's take a look at a margin of safety calculator. This one is looking at earnings per share specifically, is calculating earnings per share over the next several years based on a growth rate that we come up with. From there, we get a growth multiplier, an EPS multiplier, which will give us a target buy price. So I believe Concentrix normalized EPS for the company is around $6. From the research I've done, I believe EPS will grow around 10% per year. The reason for that is I believe the EPS, specifically in 2023, got suppressed from the Webhelp acquisition and the additional SG&A expenses and merger costs that they incurred in 2023. A lot of those merger and restructuring costs will be tapering down going into the future. The company also believes they can reduce some of their SG&A expenses by $120 million after leveraging some synergies after the acquisition. So based on all that, I come up with a target buy price of $64 here today, and the stock is trading at $65. So I would consider a buy right now based on this calculation. Next up, let's take a look at my discounted operating earnings model. This one calculates revenue out over the next several years, and then based on operating margin, we can come up with a good operating earnings for this business. And then we come up with a good market multiple of what we think the market will be willing to pay for the stock, and then we get intrinsic share price. So when I look at Concentric specifically, I believe they're going to come around $9.5 billion for 2024 on the top line for their sales number. Now, management has come out and said they should be between 9.5 billion, 9.7 billion. Everything I've read does correlate to those numbers. So in this particular projection, I'm going to be conservative, use that lower number at 9.5 billion. After that, I think their revenue is only going to grow, at least I'm projecting to only grow around 2 to 3% per year. Again, trying to be very, very conservative here. Now, before that acquisition, they were growing their revenue in the high single digits, even low double digits. So this is actually taking a very conservative approach. Now, as for an operating margin standpoint, they did around 10% last year. I think that's going to drop down to around 8% this year as they try to merge the two companies together. However, as they're able to leverage some of their synergies, I do think those operating margins are going to grow. And basically, I think they're going to get to around 9% in 2028. Keep in mind, the numbers looked at before, they've been around 10 to 11%. So again, I'm trying to be very conservative here. Now, as far as a market multiple goes, their peers have been trading around a 16 to 17. The company's been all the way up to a 25 historically. However, I'm trying to be conservative again, and I'm suggesting they'll have a market multiple of around 14. So based on the information, I come with an intrinsic share price of $101. And today the stock is trading at $65. So this is a significant margin of safety based on these numbers. Now, keep in mind the sales CAGR for the next 5 years is around 15% per year. But keep in mind, again, that's from the acquisition they made in 2023. So most of the growth that you're seeing here is non-organic. But nonetheless, the company should be growing year over year. Next, let's take a look at a 10-cap valuation. And this one really looks at owners' earnings of the business. In order to get there, we try to calculate a good free cash flow number, add in the tax provisions, divide by total shares outstanding. We get an owner's earnings per share, multiply that by 10. That's where we get the 10 cap from to come up with a good 10 cap valuation, what we think the stock should be worth. And this particular valuation does already build in some margin of safety in it. So I believe the company's free cash flow from a normalized perspective is around $470 million. The tax provision is around $50 million, which gives us total owner's equity of roughly $520 million. If we divide the shares outstanding of 66 million, we come to an owner's earnings per share of roughly 8. If we multiply that by 10, we come with a 10 cap valuation of 78. So this model suggests buying the stock anytime it's under $78. Today, again, it's trading at 65. So this model also suggests it is a buy right now. Last but not least, we're going to look at the payback time calculator. Now, this calculator and the 10 cap valuation we just looked at is a Phil Town valuation. I'm a big fan of Phil Town. I've read his books. I've taken his vesting seminars in the past. And I really like the way he looks and how he strategizes on valuing companies. And this particular model itself, I think, does a great job. It's very different than other models I've looked at. Essentially, what it's doing here is that we want to put money into the company based on their free cash flow. We want to get our money back in 8 years or less. The reason for that is historically, investors have been willing to get their money back in 16 years or less. So on a historical standpoint from the market over the last 100 years, a market multiple has been around 16 on average. So if we can get our money back in 8 years or less, there's a good chance that the stock is trading at a solid margin of safety right now. So in order to figure out the payback time number we first have to come up with a good free cash flow number, which is $470 million. That's exactly what we came up with for the 10 cap valuation. I think growth rate is around 8% per year for free cash flow. I think this is very, very conservative. I think they can actually hit around $1 billion of free cash flow in just about 3 years out. So with only 8% growth rate in 3 years, I'm suggesting they're only going to be around $600 million of free cash flow. So based on these assumptions, we get a payback time value of 7 years. So that is under 8 years. So this model is suggesting it is a buy now based on these assumptions. So let's look at a summary of the valuations that we just did. So my discounted operating earnings model suggests the fair value is $101. A 30% margin of safety would put a buy price at $71. Payback time suggests buying at $81. 10 caps suggests buying at $78. The margin of safety calculator suggests buying at $64. The stock here today is trading at 65. So 3 out of the 4 here you can see are green, which are suggesting it is a buy. I would also include the margin of safety calculator saying it's a buy as well because you're so close to that $65. So interestingly enough, all these valuation models do suggest it is a buy. But keep in mind on the risks that we talked about in this video already, and each investor is different, so you need to understand what those risks are, if it makes sense for you or not. So now let's look at a return on investment, which I would expect to get from this stock at today's stock price or future stock prices. So before I show you what the return on investment would be, I think it's first important to just summarize the assumptions that we went over in this video already. So I believe revenue is going to grow 15% per year in the top line. Operating earnings is going to be around 12% per year, and the market multiple is going to be around 14 for the stock. Now, keep in mind that sales growth and the operating earnings growth, the majority of that is non-organic growth, and a lot of that growth is coming from that Webhelp acquisition that they made in 2023. I'm only suggesting that the organic growth is going to be around 3 to 4% per year over the next several years. The company also pays out roughly a 1.8% yield for dividends, which is about $1.76 per share per year. That dividend yield is not in these return on invested numbers that I'm going to show you right now. So let's go ahead and do that. So here are the numbers now. So I believe if the stock is around $67, I think the return on investment would be 20% here today. And the stock is trading around 65. So it seems like it would be around a 20% return on investment. However, if the stock were to go up to say $82, I think the return on investment would be 15% per year. But that's based on the assumptions that we already discussed. The assumptions are wrong, then these valuations will be wrong and the return on investment will be wrong as well. But as we talked about before, based on the assumptions we went over in this video, it does look like a very good valuation here today. Thanks to all of you that have stuck with this video all the way to the end. I really do appreciate it. Now, if you want to support this channel, there's a couple ways you can do that. You can like this video. That's a huge help. If you want to go further than that, you can subscribe to my Patreon, which gives you access to my valuation templates here today. So those valuation templates that we went over in this video, the margin of safety calculator, the payback time, that discounted operating earnings model are all on my Patreon. Also have a video on there that explains how to use those valuation templates for yourself on your own research when you're looking at evaluating and valuating companies in the future. You also get access to my Discord channel with 100 other value investors, and you get access to my Patreon only posts. So if you're interested in something like that, I'll put a link down below to my Patreon. I'd love to see you over there if that's something that you would like to do. Again, thank you so much for watching this all the way through. I hope you enjoyed the video. I'll catch you on the other side. Take care and God bless.